Hi, I'm Steve LaFrance with Blakely Financial, and I'm summarizing the past 3 months in 3 minutes. Financial markets remained unsettled and volatile during Q2. The market's trend changed multiple times as investors continued to search for a direction amid a sea of changing conditions. The S&P finished its worst 3-month period since 2020 and worst first half since 1970. Inflation pressures remained top of mind as CPI accelerated at more than 8%. In response, the Fed continued to tighten monetary policy by raising rates at each of the April, May, and June meetings. Stocks continued to trade lower as the interest rate increases caused investors to dial back risk-taking. The Fed also opted not to reinvest proceeds of up to $48 billion in maturing treasuries and mortgage-backed securities each month, decreasing money supply and liquidity, and signaled another 0.75% increase at the July meeting. This may represent a turning point. Why? Throughout the first half of 22, investors were concerned the Fed was not being aggressive enough to combat inflation. The thinking was inflation could become entrenched if they raised rates too slow, which could force them to raise rates longer and higher. Their actions indicate they will now front-load rate hikes if necessary to ease these inflation pressures. The quicker inflation is under control, the sooner the Fed may slow its rate hikes and evaluate policy more rationally. Now, to be fair, there's a potential downside to this tightening approach. There isn't a clear understanding of how fast or how much their actions will impact the economy, potentially over-tightening and slowing economic activity more than expected over the next 12 to 18 months. It's a delicate balancing act for sure. This next figure tracks a range of economic indicators which remains strong relative to historic standards, but indicate the U.S. economy is beginning to soften. First, housing demand soared during the pandemic, but has declined more than 10%. Consumers are spending more at gas stations and grocery stores as gas and food prices rose and less on discretionary items such as autos, electronics, appliances, and furnishings. Consumer sentiment marked a new record low, which is concerning because spending accounts for nearly 70% of U.S. GDP. Initial jobless claims remain low, but the pace of job gains have slowed. The result was a difficult quarter for stocks, bonds, and interest rate spreads, which indicate headline fears of tightening financial conditions. The outlook is indecisive as some investors believe the Fed's actions will dramatically slow economic growth and push the economy into recession. On the opposite end, some believe the economy is strong enough to withstand the Fed's actions and view the stock market as oversold. This back and forth will likely continue until some of the market's most pressing questions are answered, including the direction of Fed policy, inflation stickiness, the trajectory of corporate earnings growth, and the path of economic growth. We think the headline risks are showing signs of stabilizing and may get better, perhaps nearing the point of maximum perceived risk, which means most of the damage is likely in the past and downside risk is already priced in. It's not to say there's no risk, but the existing risks are unlikely to keep knocking markets down. That's all for today. We hope you're having a fun, safe summer and remind you to have confidence in your plan and stay the course.